Now, the question is, should you get a 15-year mortgage or a 30-year mortgage? I think it's just going to depend on your money goals. I'm not going to put money in an HSA, make a little bit of interest that don't even keep up with inflation. I'd rather take that money again and put it in an investment account, somewhere where I have the potential to earn more money. Welcome to another episode of Becoming with Angelina Watkins, and I'm your host, Angelina, your queen of becoming, here to help you become who you need to be so you can do what you're purposed to do, so you can live the abundant life that you want to live. And this show is here to help you win at love, life, and money. We're all about personal growth and fulfillment to help you win in all areas of your life. So we're tackling all types of topics: love and relationships, money and business, any and everything that you need to know to be successful at life. And so today, I'm going to start talking about money, you all. I am approaching my 1-year anniversary that I've been doing this podcast. Yay to me! Because the statistics are most people start a podcast, don't make it past 7 episodes. And here we are at episode 46. And so I'm excited about that. I'm approaching a year. And all this time we've been talking about purpose and fulfillment and overcoming and love and relationships. But we haven't talked about money. And I want to help you win in money. So today we're going to start an 8-week run leading up to the anniversary of talking about nothing but money and business, you all. And so in today's episode, I'm going to start out with tackling some of the advice that's given on social media. Advice that circulates all around, and people have asked me, what do I think? And why do they ask me? Because I'm a licensed financial professional. I used to be a licensed financial advisor, and I was a real estate agent and a real estate investor. So I know a lot about money. I've been in the money industry a long time, along with learning and development. That's why I'm able to help people with personal growth and fulfillment. But I know a lot about money as well. So I'm going to share a little bit of my opinions on some of the advice that's being given out in social media. Okay, so we'll tackle a few. So I'm going to just go ahead and let's just dive right in. So the first advice is buy a house and get a 15-year fixed mortgage rather than a 30-year mortgage. Saves a lot of money and interest over the life of the loan. If you must get the 30-year mortgage, verify no prepayment penalty. This gives you the flexibility of paying off early if you're able, but also gives the option of making lower payments when times are tough. Now, the question is, should you get a 15-year mortgage or a 30-year mortgage? Now, that statement is true that you will pay less in interest if you get a 15-year mortgage versus a 30-year mortgage. But the question really is, should you get a 15 or a 30? And I think it's just going to depend on your money goals. I've said this before to my clients. It's going to depend on your money goals. A 15-year mortgage does give you usually a lower interest rate because it's a lower term. And so then therefore you're paying less in interest. So if your money goal is to pay the house off faster, then by all means, if you have the money to pay a higher mortgage, then you can do the 15-year. But 30-year is where I like to tell people to go. In my experience in the real estate world and in the financial world, the insurance world, the securities world, you never know what's going to happen. And see, what I like to tell people is you have this 15-year mortgage with a higher payment and you're paying more, but why? What if something happens? I like to tell people to do a 30-year and you can make extra payments. And making extra payments allows you to still pay the mortgage off faster. But if there was some catastrophic event causing you to be in a financial bind, it's going to be easier to pay that lower mortgage than the higher mortgage. But let's just take a look at the difference between a 15 and a 30-year mortgage. So you get a 15-year mortgage. It's attractive again because the interest rate is low, because the term is lower. So then what I did is I put this scenario together for you all. you have a home that's $250,000. And this is based upon putting no money down. The interest rates will vary because that's going to depend on the requirements of the loan. It's going to depend on your credit score. It's going to depend on how much money you put down. But this scenario is based on no money down with someone with a credit score around 720. So this was kind of the going rate as of today. So you got this 15-year mortgage at a 4.5 interest rate, and your payment is going to be $1,912 a month. The total interest that you're going to pay over 15 years is going to be $94,247. So the total amount you're actually paying for a $250,000 home is $344,247. Okay? Now let's look at a 30-year fixed. Now, because it's 30 years fixed, they're going to tack on a higher interest rate. So at this right now, it's about half a percent more. Your mortgage payment goes down to $1,342. The total interest you're paying is going to be more, $233,139. So the total you're paying for a $250,000 home is $483,139. So yes, when you look at the numbers, a 15-year mortgage is going to look better because the interest rate is lower, the amount of interest you're paying is lower, the amount of money that you're paying for your home is lower. However, you're paying $600 more in mortgage payments. What could you do with that additional $600 a month? That $600 a month is money that you could be putting away for your emergency fund, so that when something does happen, you're still able to pay your mortgage, and then you have money to pay for other things as well. That $600 is money that you could be taking and putting into an investment account that's earning more interest than what you're paying on your home. So let's say you took that $600 a month and you were putting that into some type of investment account that's yielding maybe, let's be generous and let's just say about 9% a year. Okay, you're paying 5% a year, but you're getting an additional 4% interest on your $600 that your money is making money for you. Now, let's do one more advice that's given. When you start your job, get an HSA account, not an FSA, and get the high deductible health insurance. It will lower your tax bracket, and the money is yours to use. You'll also earn 40% in most cases after 10K. Okay. HSA versus the FSA. What I will say after working in the life and health industry, and I used to actually sell life insurance, and I'm currently do work for an insurance company as well as a project manager. And I know how insurance works, and I know all about the HSA. And again, people are giving nice advice, but you got to do what's going to work for your budget. You're going to have to do what's going to work for you and your family. And you've got to think about long term. HSA is nice because you can take this money and save money for medical bills, and you can withdraw the money to pay for those medical bills tax-free. But what they don't tell you is when you have an HSA, you can only use that money for medical bills or things related to your health. Anything outside of that, you will have to pay taxes on the money that you withdraw. And so again, there's a penalty for using that money for anything other than what it's intended. And what I like to tell people is, do you really want to tie your money up in something that you may not use it for? I know it allows you to put $3,650 away a year if you're single or for one person, and $7,300 for a family, and that's as of 2022. And that's fine and dandy, but year after year after year, you're putting this money in there, and you're not earning a whole lot of interest a lot of times with the HSAs, especially if you have them through your local bank. they're not giving you very much interest on that money. So you're barely keeping up with inflation. And so now you've got this money that you keep putting in there and you're thinking, oh, it's tax free, I can use it for my medical. But now you've built up all this money that you can't even use for what you really need to use it for. So I would recommend, in my opinion, and this is what I do for me, you've got to do what you feel like is right for you. Because again, everybody's situations are different, everybody's budget, everybody's health, everybody's family dynamics, everything is different. So based upon me and my family and what I know, being in the financial services world, I'm not doing an HSA. I'm not going to put money in an HSA, make a little bit of interest that only keep up with inflation. I'd rather take that money again and put it in an investment account, somewhere where I have the potential to earn more money, where I could put that money and be able to use it for what I need it for and not have to pay a penalty. So that is my advice. That's just my recommendation again, but you got to do what's best for you. But please stop taking blanket advice off the social media, because all advice, while it's well intended, things are going to depend on your situation, your money goals, your budget, your family dynamics, your health. It's going to depend on what you want. And what's good for you may not be good for me. And what's good for me may not be good for the next person. Okay? But you do have to be well informed before making a decision. So there's nothing wrong with having an HSA. But you have to know that if you don't use it for health, you could more than likely have to pay penalties if you ever get audited on it. Okay? 15-year mortgage, nothing wrong with that 15-year mortgage. If you want to pay it off faster, you've got the money to pay that high mortgage and then still have money to save and invest. Okay? So do what's right for you. Do what's right for your family. All right, that's my thoughts on some of the most popular advice given on the internet. We'll continue to get into more money talks as the weeks to come. All right. Now, as always, where you are is not where you have to be. Your past does not define you. You define you. So heal, transform, and pursue you.